okay? Because there's two different ways to invest, guys. One's not right and one's not wrong. Yeah, people can make a lot of money speculating and people can make a ton of money investing. At the end of the day, your brokerage account is the scoreboard, right? So if you make an investment just off of a gut feeling and it worked out, well, the scoreboard says you won that time. Welcome back in, YouTube. It has been a long time and I missed you all so much. So we are back in the lab, back to work, back to get you on the right side of your trade or investment. We have a lot of stuff to go over today. First and foremost, guys, if you're new to the channel, you definitely want to like and subscribe. Hit that bell as we are starting to create a heck of a community here. And on top of that, guys, Vinyu, who is a subscriber, and myself are in the process of creating a discounted cash flow calculator. On top of that, a cycles investment tool. And if you guys are not familiar with cycles, it's basically what sectors perform well in what cycles. That kind of maybe sectors you might want to be overweight depending on what cycle you think we are in as far as the business cycle goes. Along with that, we obviously have a live watch list. And on top of that, we are going to put in a measure your portfolio versus the S&P. How much beta does your portfolio have versus the S&P? And what are the chances of your portfolio outperforming the S&P throughout the year? On top of that, we are looking to do a Discord. So we have a lot of stuff that I'm working with on the background here. I'm hoping to get all this stuff launched by the end of June. I want to get people away from speculating and get them to investing, okay? What we're starting to see, guys, is we're starting to see a lot of people that have been speculating that have a huge following. I'm starting to look in the comments and people are not happy with those YouTubers. So what we're gonna do today is actually break down one stock. We're gonna speculate on the stock first, and then we're gonna do a fundamental discovery on the stock and how we would truly invest on it. Okay, so two different approaches here. When I go over the fundamentals, I also go over basic technicals, okay? I'm not a brilliant person, guys, but I go over basic fundamentals. I use a small DCF calculator. I go over, are they diluting? Do they have a large TAM? Do they have the opportunity to really hit the projections that the experts are saying they're going to hit? And within that, I build a safety net, meaning that if it comes out to be on the DCF model, if it comes out to be a certain price, I want to be 20, 30, or possibly even 40% below that price, okay? So that's how I personally do the fundamental side. Along with that, I will take a look at the chart, look at the price history, kind of see where lines of support and resistance are to see where might be a good entry point for that stock, okay? Is it in a bullish trend or is it in a bearish trend? These are just some of the things that I do before I even invest in a stock. I try to figure out whereabouts is this stock? Where is the value? Where do I have an opportunity to enter this position and maximize my gains? The higher you pay for a price, the higher the price of that stock, the less of returns you're going to get on that stock. That's why it's extremely important to figure out what is the value of this stock. Are you overpaying? Are you underpaying? Do you have some safety built into your price and your projections? I think I'm going to use Palantir as kind of the stock that I want to break down. So if we go over the 1-year chart on Palantir, as we can see here, it's pretty much just traded in a channel and then finally broke down technically, and it just doesn't seem to be finding quite a bottom until recently. Okay, we had a double bottom here and it looks like it's definitely kind of trying to rebound from that. And so if I were speculating on a stock like Palantir, the first thing I would probably do is just look at the top line growth and say, here's a company growing revenue extremely aggressively, and at this point in time, the stock has dipped, and this is the 52-week low, this is the 52-week high. I'm going to buy at this price point. And at that point in time, I'm essentially speculating, okay? I haven't really dug into the numbers. I haven't really done any sort of analysis on the stock. I'm kind of just speculating and expecting the stock to go up, kind of guessing where I think fair market value is. And I would say probably 90% of people on YouTube this is the process that they personally take. And a lot of your famous YouTubers take this process, and you're starting to see them really question what they're doing. And I'm actually starting to see in the comments people actually getting upset with those individuals that have been recommending buying the dip, and the stock keeps dipping, the stock keeps dipping. As we look at a company like Palantir, it's basically shot up to $45 and it's trading between $6 to $9 right now. So where we're starting to see this divergence of now people are questioning, well, this is a market crash. Not necessarily. This is really not a market crash. This is just a valuation problem. We had tons of stimulus in the economy. We had tremendous amounts of liquidity throughout all markets. 1,100 companies went public, and SPACs was the new sexy name that everybody was jumping on. So we had all this euphoric behavior in the market and tons of capital to flock to these companies, which drove their prices up. So if I were interested in Palantir and I was speculating in the stock, I would probably be buying it just by sheer looking at the numbers and how fast they're growing revenue. I would be buying most likely be buying it probably between $22 to $23 as it hit 26 as a high. If it came down to these levels and started rebounding back up, me personally, I would be looking at it and saying, okay, this could be a deal. I'm jumping on it. Okay, I'm speculating. If we use some fundamentals and we actually create a process on figuring out how to value this company, well, let's take a look at what they're doing. First and foremost, okay, no question about it, top line revenue growth is absolutely phenomenal. And the one thing I have to highlight is the cost of revenue is really not going up on the company. So that means margins are expanding as the company's growing top line, okay? Now, this is just me looking at surface level stuff right now. Not only are they growing at a rapid rate, but you rarely see cost of revenue kind of flatline as this one is here. Okay, so right off the bat, I'm interested in this business model. Now the question becomes, at what price should I be paying for this business model? Okay, and so what we're gonna do is the company cash flowing? And as we can see here, yes, they are cash flowing, okay, or 321 million in 2021. So, pretty decent margins on top of everything else, okay? The cash flow looks pretty strong. The next thing I wanna take a look at is, when I look at top line growth and I look at revenue, the next thing I always look at, guys, is assets and liabilities and are they diluting, okay? This is basically the order that I personally do it in, okay? Everybody has their way of doing things. This is just the way I do it. And as we can see here, cash and cash equivalents is extremely strong at $2.5 billion, okay? Very, very strong cash and cash equivalents there. On top of that, what do they have for debt? Okay, so total debt for the company is 260 million. As we can see here, it was 450, a little over 450 million. So their debt is shrinking, their assets are growing. Everything is looking very, very good here, okay? Positive free cash flow. Now, here is the problem, guys, and I think you're already starting to see it if you're following along here. Shares issued, 1.5 billion, call it 1.6 to almost 1.8, to a huge jump to 2 billion shares, guys. 2 billion shares. So if we were to average this out over the next, we're going to do just a quick DCF, nothing crazy here, guys. We're going to do just a quick DCF on the company, all right? So they're roughly dumping about 210, a little over 210 million shares. So to build some safety for me, guys, I'm gonna do 225 million shares over the next 5 years, which would be 225 over a 5-year period. I can expect them to put roughly 1 billion shares on top of the shares that I have, okay? Now that's saying that maybe as time goes on, this is where the DCF model gets pretty interesting here, guys. I can either say over the next 5 years, they're definitely gonna put 1.1 billion shares on top of what's already outstanding, or I can say those shares are going to come down because I listen to the quarterly reports and they're basically saying that they're not going to be doing as much stock-based compensation. So there's a couple different ways you can really do DCF. It's very, very subjective, guys. It's really dependent on what you're trying to do here, okay? You want to paint a picture that builds safety for you as the investor. Now, that is the key. So me personally, guys, I am okay doing about $1 billion over the next 5 years. Growing revenue by 28%, and they have their weighted average cost of capital sitting right around 8%. We're looking at about a $5.50 stock, okay? Now that's with them putting 1 billion shares on the market. Now, maybe they don't, maybe they start free cash flowing more and they don't do stock-based compensation. Maybe the stock-based compensation slows down. And so maybe we're only at 2.5 million or 2.5 billion shares. If that's the case, then we're looking at a $6.80 stock, okay? Now, this is what I'm looking at. Now we can come up here and we can fiddle the numbers a little bit more and say, well, I think you're being a little biased with their growth rate. I think they can maintain a 30% growth rate. So we put a 30% growth rate in there. Now we're looking at a $7.24 stock. Okay. So you can see how this discounted cash flow calculator is very, very subjective onto what your thought process is. Now for me, I think I could be okay doing roughly around this, okay, where I can project them doing 30% revenue growth and putting an additional, 500,000 shares, 500 million shares on the market, okay, and that would put it right around a $7.24 stock. So as we can see here, guys, I have it on my watch list, Palantir at below 7, guys. So I think there's a pretty good risk versus reward at Palantir at below 7. Now, just to give you guys full disclosure, I did buy some at $7.70. I do think they're pretty innovative, and I think over the next year or two, they might slow down on the stock-based compensation. So this is me being pretty subjective with the company. So as we can see, there's definitely different processes people have. But for me personally, guys, it makes a lot more sense buying the stock around $7 than it does buying it in the 20s, okay? And that's just me personally. Now, everybody has their own method of doing things. This is not financial advice. This is just to help you have processes, right? I'm not giving you guys a fish, I'm teaching you how to fish, right? So it's kind of that process that I want to share with you guys. And it's not perfect, I don't have the answers to everything, but I think having these kind of processes can help you become a better investor. So that's why I'm trying to put together that's why we're trying to put together a whole system and a series of videos speculating versus investing, and kind of, building a fundamental case, understanding what the fundamentals are with the business, understanding the technicals of the stock. And these are some of the steps that I take before I buy a stock, and then I put it on a watch list if I'm waiting for it to hit certain price points. And that's why we're building out that watch list there. So as always, guys, appreciate your time, and I will be dropping more videos now that I'm back in town. Hopefully you guys enjoyed this one, and we will see you next time, investors. Peace.